Let's get the views of our featured guest of the morning. He's Colin Stewart, portfolio manager and CEO at JC Clark. Colin, first of all, thanks for being here.
Good to be here, Paul.
So what do you think? Pretty dramatic stuff yesterday. Should investors have been surprised that the Fed sees itself only cutting twice in 2025?
No, I don't think so. I mean, first of all, I think the market has been acting as if nothing can possibly go wrong, that the Fed was going to orchestrate this perfect soft landing, inflation coming down, rates continuing to come lower. Albeit, as we know, the economy has been quite strong, particularly in the U.S. And I think, that's sort of what happened yesterday is the Fed acknowledged that inflation has been a little bit stickier than everybody thought, and therefore, really lowered their expectation of the market for how many rate cuts we're going to see next year. And I think that, it was a little bit surprising that the market was pricing in sort of 100 basis points of rate cuts in 2025, given how strong the economy has been. So I think, it was incumbent on the Fed to reset expectations. They did that. Not surprisingly, we saw a sharp reaction. But, beyond that, I think our overall view continues to be one that, there are, particularly in the U.S. market, there's a fair bit of speculative activity in certain segments of the market, and therefore investors, need to be a little bit cautious and just selective on where they're allocating capital.
You've used the word euphoria in some recent commentary. Let's flesh that out.
Yeah, so I mean, and this is not to broad brush all segments of the market. I think one really has to look at the U.S. market, and particularly the U.S. large cap technology space. We know U.S. equity valuations are really near all-time highs. The equity risk premium, which is the premium that investors are being paid to sort of take on that extra risk in the equity market relative to the risk-free rate, is really down to zero. Goldman Sachs, for example, a few months ago came out and said, based on where valuations are today, we think the forward 10-year returns will be about 3% annually in the S&P 500. So just shows we're really not at a great starting point when you've got a forward PE multiple on the S&P 500 of 22, 23 times. And that's also with fairly heady expectations on what earnings are going to do next year. I think the analyst consensus is for about 15% EPS growth in the S&P 500. So, in our view, there's that. And then we, also look to more speculative elements of the market, things like Bitcoin. Tesla has added $600+ billion in market cap since the U.S. election. With really no change in fundamentals. We have one of the best performing stocks in the entire U.S. market, a company called MicroStrategy, whose main business proposition is to borrow money and buy Bitcoin. So I think this sort of tells investors what is going on, and it's just, we would say buyer beware. Maybe investors should consider taking a little bit of money out of some of these more, high-flying areas of the market and reallocate capital elsewhere.
You mentioned earnings, and as you know, the bulls argue that earnings will catch up to valuations this year. They think that can happen. And you mentioned what you referred to as heady expectations on earnings growth in 2025. What is your expectation on S&P 500 earnings growth this next year?
Yeah, I mean, listen, I think earnings are going to grow. I mean, assuming we don't go into a recession in the U.S. and the economy does look fairly strong. But I mean, things can happen. There are a lot of risks out there, geopolitical risks. There's obviously a lot of uncertainty around, the incoming Trump administration's policies around tariffs. If that creates a trade war with many different nations, what could that do? That's clearly going to be, as we heard the Fed acknowledge yesterday, potentially inflationary, and the market had not been worrying about that at all. And now we're seeing that the Fed is actually worried about that. So yeah, we would expect earnings to come in perhaps somewhat, lower than that 15% mark. I mean, I think historically over the very long term, S&P 500 earnings have grown at 7 or 8%. But I guess my point is, even if they do grow 15%, the market is already pricing that in at a very high multiple. Saying if they hit that number, we're still trading at pretty much all-time valuation highs. So I think a lot of things have to go well, and if any of the things that could potentially go wrong, as we saw yesterday, we could see a pullback in particularly some of those high-flying areas of the market. You
think we're in for a period of volatility and market declines over the short or midterm here?
Yeah, I think a period of volatility for sure. I mean, there's some expectation perhaps going in the last 2 weeks of the year. I'm not sure you're going to see some huge sell-off. I mean, despite what happened yesterday, because people don't want to sell things they have gains in to trigger taxes. And then, sometimes early in the new year, you might get a rotation. People saying, well, growth stocks have worked well, we should rotate into value. U.S. stocks have worked, maybe rotate into international stocks and other things like that. So often early in the year, you see this kind of rotation. And I think that and just uncertainty with central banks and what's going on with tariffs when the Trump administration comes in on January 20th, all of those things could lead to, certainly over the coming months, more volatility and a potential pullback in the market.
Okay. You also, we got about a minute left in this conversation. You're advising investors to lighten up on their U.S. exposure and to lighten up on their mega cap tech exposure.
Yeah, exactly. And I would just say, I mean, if people have had exposure to technology or investors have, it's been a huge win for many investors. We've had some of those stocks as well. And I think it's just not to suggest selling all of your technology exposure. These are great businesses, but to, I think focus on fundamentals, valuation. We would say, for example, a company, people talk about the Mag 7 stocks all the time. A company like Alphabet or Google has pretty solid fundamentals. The valuation is not really that high. It's just around a market type valuation or a little bit lower, and maybe avoid some of the other speculative various things that I mentioned before, like a Tesla, MicroStrategy, Bitcoin proxies. There are all these, single stock levered ETFs that have been seeing a lot of inflows. So really that sort of riskiest segment of the market has been attracting a lot of capital, and we would just caution that, maybe taking some capital out of those areas, reducing technology holdings and looking to perhaps reallocate for some of those things that have worked really well, like U.S. large caps, into areas like Canadian stocks, international stocks, value stocks, things that are, a little bit out of favor and are not trading at these historically high multiples.